Bom dia, pessoal. Good morning, everyone. Guten Tag nach Österreich. Before turning into English, I have some institutional information to share with you in Portuguese. Este é um evento do Núcleo de Estudos Fiscais da Fundação Getúlio Vargas, organizado pelo grupo de estudos GT7, devidamente cadastrado na instituição e nos órgãos de educação. E para aqueles que tiverem interesse, podem entrar no site da FGV, que vão encontrar todas as informações sobre o NEF e o nosso grupo. Meu nome é Paulo Duarte, eu sou responsável executivo pelo GT7, que é esse grupo de estudos, cujo responsável acadêmico é o professor Isaías Coelho, que está aqui conosco, em breve vai falar algumas palavras. Uma informação importante institucional que eu preciso ler antes de iniciar os nossos trabalhos é que as manifestações expressas por integrantes dos quadros da FGV e dos convidados aqui hoje, que participam dos eventos, transmissões online, representam exclusivamente as opiniões dos seus autores e não necessariamente a posição institucional da FGV. Reiteramos também que todos aqui presentes, tanto nesse primeiro painel quanto no segundo painel, concordaram em participar desse evento de forma espontânea e, com isso, autorizam o uso de imagem para essa transmissão, que ficará disponível posteriormente nos canais oficiais da FGV. E agora eu vou ler a mesma mensagem em inglês, porque esse evento é internacional. All statements expressed by Fundação Getúlio Vargas, employees and guests in our online events and broadcasts exclusively represent their opinion and not necessarily FGV's institutional position. We also reiterate that everyone present here agreed to participate in this event of their own free will, and they consented to be recorded in this broadcast, which will be posted later on FGV's official channels. We are initiating today the third day of our event, the New Brazilian Conventions to Avoid International Taxation, a series of webinars organized by Center of Fiscal Studies of Fundação Getúlio Vargas with the aim to discuss the recently, not newly, but recently signed and renegotiated double tax convention, their details and practical aspects over the bilateral economic relations with the various countries. We have started on Monday with the perspective of the Brazilian federal revenue. It was a really interesting event. And the following days, started yesterday, we are going to discuss each of the conventions with experts from Brazil and from the other contracting countries. Today, we are going to have two panels. The first one to discuss the double tax convention with Austria, which is being renegotiated and is very important. It's a paramount, especially to Brazilian multinationals. And the other panel with Switzerland, a very important commercial investment partner of Brazil. So between both panels, we are going to have 5 minutes break, only to have another cup of coffee, and then return back with the convention with Switzerland. I would like to invite now Professor Isaías Coelho, professor of Fundação Getúlio Vargas and the academic responsible for the GT7 group of research of the Center of Fiscal Studies of FGV. Professor Isaías, the stage is with you.
Thank you, Paul. Good morning, everybody. Welcome to this webinar, well organized by Paulo Duarte, and a part of the activity of NEF, Center for Fiscal Studies of the São Paulo Law School of FGV, Fundação Getúlio Vargas. This is a series of meetings, of discussions, and it's been very timely organized because a series of events are taking place right now, including a new revamping of Brazil's double taxation agreements, and also the new corporate income tax law, which is in the process of a reform, which will bring important changes to the legislation. No? And this has a direct impact on the economic relation, the treatment of international income. So this is very interesting. It's also timely in the sense that the international community discussing a new way of taxing multinational companies. And so a new round of multilateral cooperation is taking place in the context of OECD's BEPS initiative, and now under development of the Pillar 1 and 2. And so this has been object of the G20 meeting quite recently. So it's all this makes very timely, very important to discuss these matters. And I am pleased that we are able to gather in these panels first level experts from various countries in the world, countries with whom Brazil is engaged in significant economic relations, with a lot of tax issues still to be developed, and I would say in the making. So welcome everybody, and let's have a nice discussion here.
Thank you, Professor Isaías. Now, starting the first panel, we have the honor to have here today as the speakers, Renato Coelho, partner of the law firm Stock Forbes Advogados, my partner, LLM by the Leiden University in International Taxation, Bachelor of Economy by FEA USP, and Bachelor of Laws by PUC São Paulo. And from Austria, Clemens Schindler, partner of Schindler Attorneys in Vienna, Austria, doctor by the Vienna University of Economics and Business and by the University of Vienna, LLM by the New York University, and Bachelor of Laws by the University of Vienna. So I invite Renato to initiate his exposition. You have 25 minutes. Renato, then we will pass to Clemens to make his considerations for more 25 minutes. And if we have time, we will debate and make some questions to you up to our final time of the presentation here today. So Renato, the stage is with you. Go on.
Thank you, Paulo. Thank you, Isaías. Good morning. Thank you, Clemens. Good morning, everyone. Let me share the screen. I have a presentation here for you. Can you all see my screen?
Yep.
Okay. So as we've been discussing since Monday, the Brazil government did not sign the MLI, and it decided to, for practical reasons, to submit several protocols before the Congress. It decided to renegotiate several treaties, the treaty network, both in order to align with the treaty with BEPS initiatives, but also to revisit certain treaty policies that seems outdated when comparing to the current world and economy. And in order to check what would be the main negotiations that are taking place between Austria and Brazil, we should first consider the historical background and the context in which the treaty with Austria was negotiated. Yeah? The treaty was signed in 1975 during our military regime. It was a period of strong intervention in the state, and the government wanted to foment industries, domestic industry and foreign industry in Brazil in different ways. And one of the ways to foment was through tax incentives. So at that time, the way that Brazil was negotiating the treaty was from the perspective of a source country. We were a capital import jurisdiction. So our negotiation took that assumption, and mainly in that decade, in the decade of 70s, the negotiation took place mainly with developed countries from the perspective of Brazil as a capital importing jurisdiction. So in that decade, in addition to the Austrian treaty, we signed treaty with Germany, Belgium, Spain, Denmark, France, Italy, Luxembourg, and Sweden. As a capital importer jurisdiction, and take into consideration that the intention was to foment foreign investment in Brazil, the focus of the negotiation was to provide tax incentives to the investor in Brazil and not shift the tax revenue to the residence country. So that's the reason why most of the treaties signed at that time, including certain aspects such as the exemption method and the matching credit that we can see in the tax treaty with Austria, that would make sure that the investment and the tax benefit would remain with the investor in Brazil, which would not occur if the credit method was introduced, since the tax benefit would be shifted to the residence country. So that's the perspective, the historical background in which the tax treaty with Austria was negotiated in Brazil. It was from the perspective of a capital importer jurisdiction, and important tax benefits were to be granted to the foreign investors, and the mechanisms in order to preserve just this tax incentives to the foreign investors would be through matching credits and tax exemptions, as we may see in the tax treaty currently in force with Austria. So if we analyze the treaty in force, I will highlight certain important aspects that we have to consider. Of course, there is this Article 7 in this treaty in which the profit of a company shall only be taxed in the resident state unless there is a permanent established in the source state. But an important aspect of this treaty is that the protocol does not treat the payment of services as royalties, as we may see in many other treaties celebrated by Brazil, which means that from the perspective of the existing treaty with Austria, the payment of services will fall under Article 7 or Article 14, as the case may be, and there would be no taxation at source either by Brazil or by Austria. This is a very important and unique aspect that we may see in the treaty with Austria. Another important aspect is that Article 9 of the corresponding existing treaty has no paragraph 2, as there is no in many other treaties, I would say in all other treaties celebrated by Brazil. So currently there is no corresponding adjustment for transfer pricing purpose, which means that any agreement should be made through the MEP, Mutual Agreement Procedure, which so far is a little ineffective, mainly for transfer pricing purposes due to the fixed margins that we have here with respect to our transfer pricing rules. Article 10 of the current treaty limits to 15% the corresponding withholding income tax on dividend payment, and also to 15% for the payment of interest. the taxation is limited to 10% for the payment of royalties with respect to author's right, 25% to trademarks, and 50% to all other cases. And there is in this treaty, Article 14, independent personal services, that tax in a similar way of Article 7, in the same that the taxation of such services can only occur in the resident state unless a permanent establishment exists in the source state. Bear in mind again that our protocol does not consider services, our protocol with Austria does not consider services or royalties for the purpose of the treaty. I would say that one of the most important aspects of the treaty with Austria is Article 23 for the methods to eliminate double taxation. Today, as I mentioned to you, due to historical reasons, there is a 25% matching credit for royalties, interest, and dividends if the participation is less than 25% when paid to an Austrian, when paid by a Brazilian person to an Austrian resident. And in addition to this matching credit of 25%, there is also full exemption for dividends received either by a Brazilian company or by an Austrian company. This exemption exists in the treaty. It's a very important tax policy, and it's used by many Brazilian multinationals in Brazil, which invest abroad and use Austria as a hub for the offshore investment, since it would prevent Brazil from applying its CFC rules. There is, as you may know, there is a huge discussion on whether Article 7 of the corresponding treaty prevails over the existing domestic CFC rules. But when we have an exemption method, as it is in the tax treaty with Austria, we have an additional argument in the sense that even if Article 7 is not applicable with respect to CFC rules, the combination of Article 7 with the exemption provided by Article 23 would prevent Brazil from taxing the corresponding profits from the Austrian company. So that's the reason why this is a very important treaty aspect that has been used by many Brazilian multinationals to invest offshore. Then we go to the treaty that's under the renegotiation that is taking place between Brazil and Austria. This is the renegotiation was basically a Brazilian initiative. As I mentioned to you, Brazil has participated intensively in the BEPS project, participation in the discussion, but not signed the MLI. Since our treaty network is relatively small, Brazil chose to renegotiate the existing treaties on a case-by-case approach rather than submitting several protocols to the Brazilian Congress, which would likely take much longer when compared to a bilateral negotiation with the other jurisdictions. So today, the treaty with Austria is under negotiation, and basically the main possible changes that are being negotiated between Brazil and Austria would be first, again, Article 9. Austria has requested the insertion of paragraph 2 and Article 9 of the corresponding treaty in order to have corresponding adjustment for transfer pricing purpose. It would be a commitment from the Brazilian government to eliminate double taxation, but it seems extremely unlikely that Brazil will accept this change in the treaty, since none of the treaties celebrated by Brazil has such clause, and Brazil prefers to theoretically use the mutual agreement procedure in order to solve aspects related to transfer pricing issues. Based on also Brazil request, Article 10 dividends would limit to 10% the withholding income tax on dividends payment. Bear in mind that we are, as mentioned by Professor Isaias, Brazil tends to impose withholding income tax on dividend payments. So the proposal of Brazil is to limit to 10% the payment, the withholding income tax on dividends payment if the participation is at least 25%, and 15% in all other cases. Whereas for the Austrian perspective, the request would be a 0% of withholding income tax if participation is at least 10%, and 15% in all other cases. With respect to interest payment, the Brazilian proposal is to limit to 10% the taxation at source if the beneficial owner is a bank and the loan has been granted for a minimum period of 5 years for the finance of acquisition of equipment or investment projects, in 15% in all other cases, whereas Austria requests a limit to 10% the withholding income tax on interest payment. And with respect to royalties, the proposal of Brazil under the treaty that is being renegotiated is to limit to 15% the withholding income tax on royalties related to trademarks and 10% in all other cases. An important aspect that is in accordance, as we have seen in these panels this week, is in accordance with the new treaties signed in Brazil, is the request by the Brazilian government to insert Article 12A in the treaties so that it would be possible to tax technical services by the source country, and based on this request, limited to 10%. As we may know, there is a huge discussion before our courts as to whether technical services that involve the transfer of technology should fall under the concept of royalties, which means that the source country would be allowed to tax the corresponding income. And the intention of the Brazilian government is to solve this litigation by inserting a specific article that deals with the taxation of technical services and consider for such purpose a broad concept of technical services to include the provision of services of managerial, technical, or advisory nature in order to eliminate or put an end on the discussion about the application of Article 12, Article 7, or Article 14 with respect to technical services provided by the source country. As present in other tax treaties celebrated with Brazil, the Brazilian request would be to insert in Article 12.1 other income in the treaty and allow the source country to tax the corresponding income. But the Austrian request, and based on the OECD recommendation, would be that Article 12 would allow only the resident state to tax the income classified under Article 21. And then we go to to Article 23 for the methods for the elimination of double taxation. The proposal that is being under negotiation is the replacement of the exemption method for a credit method with respect to dividends payment, and also the elimination of the matching credit currently provided by Austria under the assumption that Brazil is not anymore a developed country, and even OCDE since 1998 has recommended to revisit the negotiation of matching credit because it could lead to abusive tax behaviors by the companies, and also this is something that from a tax policy perspective seems not to be quite effective. And due to BEPS initiatives, the renegotiation also includes the Article 26A, which would limit the benefits of convention to qualified persons. And also the treaty, the negotiation includes a principal purpose test that together with the preamble, the amendment of the preamble of the convention would make sure that tax avoidance is one of the purpose, avoid the tax avoidance, combat the tax avoidance is one of the purpose of the treaty. And finally, with respect to the protocol, the proposal of Brazil would be to include in the definition of the royalties, the remuneration for the provision of technical support services, again, to deal with the whole huge litigation that's currently in Brazil with respect to the qualification of technical services as royalties for the purpose of the treaty. And the intention is also to expressly consider our CFC rules within as compatible with the treaty, although our control foreign corporation rules in Brazil are quite unique and are not properly a domestic anti-avoidance rule, since any profit derived by the CFCs here in Brazil are taxed regardless of the nature of the income and the corresponding location of the CFC. So in very general terms, in order to summarize what I've just presented here, there are important changes in the Austrian-Brazil treaty that's under negotiation, which may have an important impact on bilateral relations. The change of the exemption method for the credit method is something very important and necessary to discuss, because the exemption method is a tax policy to foment Brazilian multinationals to invest offshore and be competitive with other multinationals within the world. And maybe the Brazilian government and the Austrian government could reconsider the replacement of the exemption method and deal with the abuse of the convention with other measures, such as dealing with the principal purpose test. And another aspect that may have impact on bilateral relations would be the taxation of services income that should remain as it is today, or under Article 7 of the treaty, based on OECD guidance, which means no taxation in the source country, which would impair the flow of services between Austria and Brazil. So basically, those are the changes that are being negotiated by Brazil. I'm available to discuss after the presentation of Clemens any question that remains open with respect to that. Thank you. Thank you very much.
Thank you, Renato. Really very important points that you brought, not only from a Brazilian perspective, I mean, from the perspective of the Brazilian companies doing business in Austria, but also the Austrian companies doing business in Brazil. really relevant, and we hope to discuss this later after Clemens' presentation. Clemens, guten Morgen, eigentlich guten Tag. So the stage is with you. Be our guest, and we are very excited to hear your presentation.
Well, thank you very much for inviting me to this panel. I'm really delighted to be here. Unfortunately, not in presence. So when I actually accepted the invitation, I was hoping that we will actually meet in person. Let me just see how we here connect to the screen. Yeah, now it works. So I was hoping that we will actually meet in person instead of here just being on the video screen, but nonetheless, it's a great pleasure. And I really regret that since the Corona crisis started now approximately 2 years ago, I had no chance to visit Brazil, which for me, after probably way more than 50 visits between 2010 and 2019, shows the relevance of doing business by Brazilian companies in Austria and vice versa. So I think that the topic is, of course, of great concern to many companies that are already invested from both countries, and accordingly, I think it's very important now that the treaty is under negotiation, which was, being caught by rumors for many years, is something that is obviously then also followed by an academic discussion, but also by input from the taxpayers, the respective companies that obviously have certain needs, and I think the more we contribute here, the better. Maybe very briefly to my personal background. So besides being very active in the Brazilian market, advising mainly Brazilian companies on their structures, I've also acted as an expert for the Chamber of Austrian auditors and tax advisors in relation to the treaty negotiations. So in that context, I was a member also of the group that then provided expert comments to the Austrian Ministry of Finance on the renegotiation of the treaty. And already a few years ago, when Austria was put on the blacklist, also advised the Austrian government in relation to the blacklisting of Austria. So in addition to having kind of the advisor side, I've always closely engaged also with legislative proposals as well as proposed treaty amendments. Now, I think Renato has presented the proposed amendments in a perfect and comprehensive way. Shows that we look at it from a very same perspective. And so I will probably, skip a few slides on my presentation, so not to bore the audience, because I think we simply do have a certain overlap in our presentations. But I would like to kind of first switch to, yes, 1 second, somehow, unfortunately, through the system, it's not reacting as quickly as it should. Sorry, 1 second. I actually wanted to jump already to slide number 4. I'm sorry for the delay. Let's jump to 4. But anyhow, I'll continue with my presentation until the moment where we're on slide 4. Yes, exactly. So that's what I wanted to see. So here you have an overview of some of the amendments, and I have put some kind of overall topic above it, so that you see under what kind of topic Austria would see those amendments. And if I switch to the left side, there are maybe 2 things that, so to say, I would like to highlight specifically. One is also in Article 5 regarding the amendments of permanent establishments. So here I think one thing that I should still comment is that Austria would consider exemptions for particularly ancillary services or temporary services under the permanent establishment clause only if it's not the main activity of the branch and the company. Yes, so I think that's an important exclusion. I've called it here the main activity test. And that shall actually be introduced in the current draft. I think it's something that you see quite often in OECD treaties, but which may not immediately jump into your eyes when you look at the treaty. So it would be a kind of the last sentence of Article 4 on the amendment of Article 5. Where it says that you will check whether it's the main activity. And if it's the main activity of the company, despite the fact that it may be only an ancillary service or temporary service, under the treaty, it would then be considered, not within that exemption. I think that can be relevant, particularly for structures like finance branches that we have seen sometimes in the past. Another topic that now, particularly in our advisory practice, has of course been very, very relevant is also the amendment to Article 19. Renato mentioned it, where certain domestic regimes shall apply irrespective of the treaty, so they should not be irrespective of the treaty. And it's pretty clear to us, after also having here provided our expert comments to the Ministry of Finance, that the Austrian Ministry of Finance was not aware that the Brazilian CFC rules, are so broad and actually go way beyond what usually CFC rules in the sense of anti-abuse rules would try to capture. So we actually do believe, and also after having contributed quite detailed information about that to the Austrian Ministry of Finance, that there is a sensitivity for the Austrian authorities that the Brazilian CFC rules may not necessarily apply to kind of the context that is known and that is known in the anti-abuse context.
Clemens, sorry to interrupt, but we are not seeing the slide 4. For us, it's not appearing. So,
I'm sorry for that. We will. We'll try to share it once again. Sorry for that. Thanks. Good. So, speaking of, can you see it now?
Yes, we can see this way, yes.
Okay, so unfortunately, if I fold it up, unfortunately you can't see it. So I hope it works this way. Let's jump just to slide 4. Yes, sorry for that. In context with the CFC rules, Renato already mentioned Article 23, paragraph 2. This rule, this exemption for dividends, is a rule that Austria had, so to say, in the negotiations, no problem to give up, because they did not have the sensibility in what circumstances it may be applicable. And generally speaking, the one is, of course, the CFC rules under Brazilian law, where I think the Austrian Ministry of Finance now has a certain awareness that this clause, will have quite some relevance. But another case that I would like to mention, because it's quite frequently used also by Brazilian companies, are the so-called repayments of capital or repayments of contribution under Austrian law. In a lot of the structures with Brazil, through various ways, the Brazilian shareholders have, so to say, contributed either in a formal or in an informal way, contributions to the Austrian company. One of the most important examples are the typical trading structures that you can find on the market, where, in fact, due to a mismatch of the transfer pricing rules between Austria and Brazil, a certain amount is considered not a profit in Austria, but a so-called informal capital contribution. So those are the so-called infocap structures, which are quite common. And that part of the profit that is considered a contribution has two consequences. On the one hand, that part will not be considered a profit in Austria and accordingly will not be taxed in Austria, with the rationale that as long as Austria follows OECD principles and as long as the Austrian entity follows OECD principles, that Austrian authorities would generally accept that. But the second part was that through the informal capital contribution, a capital reserve was created in the accounts of the Austrian company. The capital reserve is part of the equity of the company, so it's not statutory share capital, but it's a capital reserve that is below the statutory share capital. And such capital reserve, for example, in the situation of InfoCap structures, but sometimes also in other structures, is typically repayable to the shareholder. In some cases, you may see restrictions on repayment, but clearly not in those trading structures. So in those trading structures, that amount, the capital reserves, could generally be used for repayment to the shareholder. And now we are coming to the relevant part in connection with Article 23, paragraph 2. Such repayment would not trigger withholding taxes in Austria. So whereas the current treaty foresees a withholding tax of 15%, under this repayment of capital, you would not be subject to domestic withholding tax of 15% in Austria. So that would mean that that was quite a common way also to repatriate funds from Austria to Brazil, free of withholding tax. Now, our understanding is that in Brazil, the view is taken that such a repayment of capital should actually be treated as a dividend, which in the future, if the exemption does not apply, could of course create problems in Brazil. So I think that's a topic where it would be nice to have a discussion. On the other hand, if the withholding tax on dividends would be fully repealed as requested by Austria, then of course from the mere Austrian perspective, there would not be the need to make repayments of capital anymore. There would be no need for it, and accordingly also regular dividends would be free of withholding tax. So we need to finally see how the negotiation will be finalized in that context. But of course, this is, I think, a very important topic. Next topic on the very right side of this slide is the matching credit. Renato mentioned it. Here, I'm afraid that Austria will give up on the matching credit for a simple reason that it's not a common clause in its treaties. And indeed, they consider that structures under the matching credit have constituted kind of aggressive tax planning. That's even part of the, if you like, legislative comments that the Ministry of Finance prepared in connection with the drafts. So as regards to the matching credit, I'm afraid that the Austrian Ministry of Finance will not be open to kind of taking a strong position to maintain that clause. And I think it's likely for them to give it up. If we move to the next slide very briefly, what is very unusual for Austrian treaties is this French profit tax. Article 10, paragraph 5, where now the so-called proposal is to reduce it to a 10% withholding tax. So I think here Austria generally, it's not a big topic for Brazilians investing into Austria. I think it's more a topic for Austrians investing into Brazil. But I just want to briefly mention that that is a clause unusual for Austria. And I think Austria would rather prefer to have it removed as opposed to keeping it. And if it's kept, then certainly any reduction of the withholding tax would be appreciated. We've discussed paragraph 23 and in particularly here paragraph 2. So here I've also mentioned that also the Austrian Chamber of Auditors and Tax Advisors have recommended the Austrian Ministry of Finance to consider keeping Article 23, paragraph 2, also in relation to Brazilian law 12973 from 14, so our famous CFC legislation. So I think it's a topic that is so to say brought to the attention of the Austrian Ministry of Finance. Jumping to the next slide, I think one more point that we should maybe briefly cover is also in Article 23, paragraph 3, subparagraph B, is that, so to say, a special clause is subject to tax clause that, so to say, certain so to say exemptions shall not apply unless it's taxed in the other country. Again, this comes a bit from this avoidance of double non-taxation, and kind of is an approach that Austria, as well as many European countries, are following. So I think it's also something where Austria will like it to be included. So I briefly wanted to mention that topic also. Now, with royalties, I think this will also be part of the discussion. There are very strong feelings in Austria not to include that clause and not to include a withholding tax. So if you look at the submission by this Chamber of Auditors and Tax Advisors here in Austria to the Ministry of Finance, the two areas that received most comments were actually the Brazilian CFC legislation and the withholding tax on technical services. So from a mere Austrian perspective, there is a high preference of not to include a specific clause for technical services. Last but not least, I would like to mention one point of Austrian legislation, because Paulo asked us also to briefly see where the ATAD, so the EU Anti-Tax Avoidance Directive, comes into play. And I would say, with regard to Brazil, probably one of the most relevant areas is the so-called interest barrier rule, or the interest limitation rule. It's a rule that was introduced by the ATAD, and that actually Austria really tried not to introduce. Austria never had such a rule, however was forced now through the ATAD as well as the Commission, because Austria actually wanted to defer introduction of that rule. But the European Commission requested that it will be introduced earlier, so it was introduced recently. And it's eventually a rule that says that you can deduct your interest surplus. So it's the difference between the interest income and the deductible interest expenses, only up to 30% of your fiscal EBITDA. This is exactly the threshold that you would also see in the German rule, and you have a safe harbor of up to 3 million. Now, generally, this is something that clearly limits a lot the applicability of financing structures, and it's a rule that you now have across Europe. And one of the most relevant areas where that could come into play was the structure of so-called jouissance rights, or profit participation rights, used by many Brazilian companies in the past. Generally speaking, the reason to use those jouissance rights or profit participation rights was twofold. The one was to kind of reduce or wash out the Austrian tax base, so to kind of reduce taxable profits by payments under the jouissance rights, which would be considered interest if properly structured for Austrian purposes. And exactly that wash out, that reduction of tax base would, in such structures, not or only to a very limited extent be possible in the future in Austria, but also in other member states, because this interest barrier rule is a result of the tax. The second aspect why those jouissance rights have been used in Austria as well as in Brazil was the argument that if considered interest in Austria, they are not subject to withholding tax. So in comparison to dividends, you could avoid the 15% withholding tax by issuing a debt-like jouissance right. And from a Brazilian perspective, it was always the question, is it Article 10 or not? Is it part of the participation exemption in Article 23, paragraph 2? Yeah, I think so from my know-how from what Brazilian companies have put in place, I think it's another topic that may be interesting for our discussion to follow. So that would be my presentation, my formal presentation, and I'm handing over again to Paulo to initiate our discussion. Thank you very much.
Clement, thank you very much. You brought also very important aspect from a very practical perspective, especially because you are used to work and to assist Brazilian companies doing business in Austria. I have here some questions from the audience, and I will also make my own to you both. I will start with the most important one, from my perspective, is that this double tax convention is old, but it's a very important instrument, especially from a Brazilian perspective, from the perspective of the Brazilian companies, to make use of Austria as an investment platform, not only because of the taxes, because Austria is much more than taxes. Austria is a platform for investment besides taxes, because of the easiness to make business, the source of main force, education, and any other aspects. But from a tax perspective, what is the likelihood of these measures, these amendments being proposed by Brazil to be fully accepted or partially accepted, but the main points like exemption of dividends and introduction of a service, a tax on services, a withholding tax on service. I know that you have already mentioned this point, but when you look back, all treaties being negotiated and those already renegotiated and signed, Brazil was able to introduce a tax, a withholding tax on services. I know that Austria has also other competitors in Europe. I would mention here the Netherlands. I would mention here Luxembourg, that are also two used investment platform for Brazilian companies doing business in Brazil, and also from foreign companies doing business in Brazil. In your opinion, accepting such amendments would put Austria in a less interesting position for Brazilian companies to do business abroad and foreign companies doing business in Brazil? I would initiate with you, Clemens. What the likelihood of such amendments be accepted by the Austrian government?
Yes. Thank you very much. I think let's start with the first one. So the exemption of dividends, Article 23, paragraph 2. I think that was a clause where in the negotiations so far, the Austrian Ministry of Finance was simply not aware of the I think, implications of giving up the clause. Because from a mere Austrian perspective, we have dividend exemption under domestic law. So accordingly, you know, there was no real need to keep, so to say, such a rule, right? So I guess they really haven't seen the rationale. And I think the most important part in that context, and that, however, ties in also to the new clause that, so to say, grandfather CFC legislation, is to really make aware the Austrian Ministry of Finance and the respective department that actually those CFC rules really go way beyond what is typically considered CFC. So I think you know, there is a slight chance that now with additional input they will kind of go into that discussion. So far they haven't seen the real benefit to keep the clause, because from an Austrian perspective it was really not necessary. But here probably they were not you know, fully prepared on the discussion, and so I hope that now with some additional input it will happen. On the other hand, and that will mainly, eventually will mainly relate now to the Brazilian companies. Whereas the technical services is quite a different topic that also relates, of course, to Austrian companies. And I think that here, although it's not a common clause for Austria, they have simply, given the background and the location of Brazil, I think considered that if it's common for Brazil, let's talk about it. So I do not see a reservation in the current draft and proposal, whereas in other points you see reservations of Austria, where they take different positions. You don't see it on that point, but I think that here the pushback also by the Austrian industry was quite substantial. And I could well imagine that here they would even have a higher kind of personal intention to strongly negotiate that clause, because they see that it will then also substantially apply to Austrian companies. And here the pushback was quite substantial, and that it would particularly be considered very broadly, which simply is something very unknown to us. So in Austria, it would eventually always require some fixed presence, even if not a permanent establishment, at least some presence, right? And if you now suddenly have a clause that applies irrespective of where you are and how you do the job, then it would be very, very different to the typical approach in Austria. So I would say, yes, those 2 points are, and we need to continuously bring it to the attention of the Ministry of Finance, but I think those 2 points are points that at least will be under discussion. Whereas, for example, the matching credits, I think is gone, right? I mean, we have to see that. I think here there is really not even a slight chance that Austria will fight for keeping the matching credit there.
Thank you. No, exactly. And on the other way, we need also to make it clear to the companies doing business in this bilateral relation to also give their position to both tax authorities about keeping the main and most important clause, not let them negotiate and change the way they like. Perfect. Renato, I have here 2 questions to you coming from the audience. The first one is about the tax reform being discussed in Brazil, especially the reduction of the corporate income tax and maybe the reintroduction of a tax on dividends. How this tax reform would influence or jeopardize the negotiations of the treaty with Austria?
I think that the main point would be on the withholding income tax on dividends payment. Currently, Brazil does not impose taxes on dividends. So to limit Article 10 limit from a Brazilian perspective, Article 10 limiting the source country as a Brazil to impose dividends is ineffective because the dividends are fully exempt. But at the time that the tax reform starts imposing withholding income tax on dividends payment, then a treaty would limit to 10%, 15%, whichever rate is negotiated, would be important in order to put a cap on the corresponding withholding income tax to be imposed by Brazil. So there is an important aspect to be considered, since it's likely that at a certain point in time, dividends in Brazil will start being taxed. And then we will need the treaty, again, from the perspective of Brazil, the source country for the paying dividends, we'll need a treaty, and we'll need a cap within Article 10 of the treaty in order to limit the power of Brazil to impose the full tax rate of the dividends payment. So those are I believe those are the main aspects that will have impact on the tax reform.
Great. Clemens brought also a point regarding CFC and the position of Brazil to include the exclusion of CFC to be covered by the new convention, because Brazilian CFC does not the rules do not match what the world sees as CFC rules, a much more other kind of a taxation than really to avoid abuse. But from the perspective of the federal revenue, and we had the chance to hear from them in our webinar, these CFC rules are there is no concept, there is no international concept, but they are used to try to avoid misuse, abuse of the conventions, of the legislation, domestic legislation of all the countries, but there is no accepted concept. My point is, we are facing now some developments in the case law, the administrative case law in Brazil. Observing the double tax treaty now available, now in use with Austria, do you see this convention as a blockage, as a mean to block the use, the applicants of the CFC rules here in Brazil? Do you think, from your perspective in analyzing the case law today, that the convention with Austria is able to block, from a legal perspective, the CFC rules? And how do you look this aim of the Brazilian revenue to introduce in all the conventions the acceptance of CFC rules in the conventions?
This is for me, right?
Yes.
As I mentioned in the presentation, I mean, the main discussion that's not related to the Austria Treaty, it is applicable to all of the treaties celebrated in Brazil, is whether or not Article 7 of the treaty, of any treaty, would prevent Brazil from applying its CFC rules. The unique feature of the Austrian treaty, also with Spain and before, not only anymore, but before Argentina and a few other treaties, is that not only Article 7 would be used as an argument to prevent Brazil from applying its CFC rules, but also the application of the exemption method. Otherwise, the exemption method would be simply ineffective. So there is this important feature in the Austrian Convention. Again, this is not the only argument, because still Article 7 would still be applicable. We have recent decisions from the administrative court applying Article 7 of the corresponding treaty and blocking the Brazil from imposing the corresponding withholding income tax. But so far, until we have the exemption method in the treaty with Austria, the position of the Brazilian taxpayer or the Brazilian multinational investment offshore would be stronger, because it could apply other Article 7 as it has been decided by the case law, but also in a subsidiary matter apply the exemption method. Otherwise, the exemption would be simply ineffective. So by revoking or by replacing the exemption method for a credit method, that's the Brazilian multinational would still count with the Article 7 argument, but it would lose the application of the argument of Article 23.
Perfect. Very clear. Thank you. Clemens, I have here another question to you. You remember, because we worked together in this case back in 2016, when Brazil inserted the Austrian holdings in the gray list, and we tried and we succeeded to partially remove the holdings, except those without substance. From that date up to now, we are talking about 5 years. How, in your perspective, from Austria perspective, did this inclusion affected the bilateral economy, the bilateral relation between both countries? Did you see any harm? Was, in practical terms, the relation affected? Some companies did have problems with this inclusion. Can you bring us some information about this?
Yes, no, happy. Well, to be honest, the inclusion as it was revised, so with this clause to say it depends on the substance, actually made my work a lot easier. Because as an advisor, I've always tried to convince the Brazilian companies and clients that you simply require a certain level of substance. So that was also the part of advice we have rendered long before the inclusion on the gray list, yeah. And probably really it finally brought us to the point where this argument was much better accepted internally inside the companies than before. Because particularly the trust companies have taken a rather aggressive approach on that, because eventually, the trust companies would obviously benefit from situations where outside directors where, so to say, also domiciliation structures would apply. And with the substance requirement, I think it rather improved the situation also for the Brazilian companies. So also from the Austrian perspective, a certain level of substance is required. And there is, for example, also a guidance from the Austrian Ministry of Finance that actually if you apply for rulings, you also need to show that you have certain substance. And in this note, they have actually explicitly said that the use of trust companies and external services provider for domiciliation and for management is an indication that eventually you are participating in harmful tax planning and that you lack the required substance. So I would say for the cases that we really consider proper and justifiable, it did not have a negative consequence. I'm sure that certain structures due to it may not be maintained or maybe were not implemented, but probably those were structures that were very aggressive and that maybe also, even if of course we all have one intention, that even though we are not sorry that they are gone, right? So I think it brought us to let's say a level that should be acceptable for everyone. And internally, to be honest, it also helped a lot of let's say head of taxes or tax officers inside the companies to justify a certain budget for it. Because I had many situations where someone in the tax department would say, listen, I can easily get some budget for to pay your fees, even if it's double the fees, but I don't have the competence internally to rent an office or hire an inside employee. And with that development, I think they suddenly had credibility inside the company that they said, okay, guys, we need substance. And then they had it black on white. And so it was able to then internally to justify additional budgets for employees, for premises, etc. So from my perspective, this, as amended, was then actually a quite improvement of the overall situation.
Perfect. Clemens, Renato, thank you very much. You were really transparent, clear in all your position. You brought really very important aspect of the bilateral relationship between Austria and Brazil. And Austria is a very important partner of Brazil. And we are sure you gave us light to such a moment that we live right now, and especially because Brazil and Austria started to renegotiate this very important treaty. So if you want to make your final words, Renato, if you could start, so we can end this with you, and with
Sure,
pleasure.
thank you for this panel and for this high-level discussion. I'm very pleased to be here. I would end my speech saying that the purpose of the treaty is not only to avoid abusive situations. So my concerns that due to BEPS measure, the Brazilian government is focusing on amending the treaty in order to address only BEPS issues, but we also have to take into consideration that the purpose of the treaty is to foment the bilateral business and the economics between the contracting states. So the government should take a careful look in changing the taxation. Although it's unlikely that Brazil will change its position, the Brazilian government should take a careful look in changing the exemption method and imposing a withholding income tax on services payment when dealing with the treaty with Austria, because this is an important hub for Brazilian multinationals to invest offshore. So this is something that we have to take a look at more deeply. But thank you for the panel.
Yeah, maybe from my perspective, in those, let's say, last 10, 15 years that I've been intensively engaged in structures with Brazil, there was, of course, sometimes the discussion, okay, which is the better jurisdiction? Is it Spain? Is it the Netherlands? And you kind of always had some kind of competition between the various countries. I think one thing that is important to add is that now with this EU anti-avoidance tax directive, this competition is fairly coming to an end, because most of the restrictions on current structures will actually, so to say, be a result of that harmonization of EU law. So within EU, the competition will clearly be smaller and the differences will be smaller. The differences that, however, remain in place are differences under the treaty network and differences in the treaty provisions. So also from that perspective, I think, if the clauses in Austria are removed from the treaty, everyone should understand that that simply doesn't mean that you can then go to Spain or the Netherlands to receive something that you're not receiving in Austria anymore, but the kind of consequence is much higher. So having certain benefits in the treaty, is something that avoids that this kind of one basket used now from the EU for all the topics, irrespective of the national regimes, would apply. And accordingly, I think another good reason to try to still, receive certain amendments to the current proposal. Thank you very much for inviting me to this presentation. It was a bit light, and hopefully the next seminar will again be in presence in Sao Paulo or Rio. Thank you.
Very nice to have you here.
Professor Isaias, do you want to say? Do you want to say the final words?
I know, Paulo, just to remark that it was a pleasant discussion, quite technical, but very clear on the points made. And let's hope, as Clement says, that next year we can repeat this in Sao Paulo. Yeah. Thank you very much for participation of Renato and Clemens and you.
Thank you. So we have finalized our panel. We have 2-3 minutes more for the next panel. We'll make a short break, and we'll return then in 3-4 minutes at most. Thank you very much.
Thank you all.
som, tudo bem? Então, Paulo, então você vai fazer uma introdução.
Bom dia, pessoal. Good morning, everyone. Guten Tag nach Schweiz. Before turning to English, I have also some institutional information that I shared with the participants at the beginning, the first panel. I will speak in Portuguese, Fabienne, just a moment, then we turn into English again, okay? Danke. Este é um evento do Núcleo de Estudos Fiscais, da FGV, organizado pelo Grupo de Estudos GT7, que é devidamente cadastrado na instituição e nos órgãos de educação, que pode ser acessado pelo site da FGV. Para quem não estava participando do primeiro painel, meu nome é Paulo Duarte, eu sou o responsável executivo pelo GT7, este grupo de estudos, cujo responsável acadêmico é o professor Isaías Coelho, aqui hoje conosco. Uma informação importante institucional que eu preciso ler aqui antes da gente iniciar é que as manifestações expressas por integrantes dos quadros da FGV e por convidados que participam dos eventos e transmissões online representam exclusivamente as opiniões dos autores e não necessariamente a posição institucional da FGV. E nós reiteramos também que todos aqui presentes, em ambos os painéis, concordamos em participar desse evento de forma espontânea e, com isso, autorizamos o uso de nossa imagem para essa transmissão, que ficará disponível posteriormente nos canais oficiais da FGV. And now, in English, also for you, some statements and some information before initiating our works here today. That all statements expressed by Fundação Getúlio Vargas employees and our guests here today in our online events and broadcasts exclusively represent their opinions and not necessarily FGV's institutional position. We also reiterate that everyone present here agreed to participate in this event of their own free will, and they consented to be recorded in this broadcast, which will be posted later on FGV's official channels. Now, we are everyone here today not to hear me, but to hear our special guests, Fabienne and Victor. I will let my colleague and friend, Michelle, to take care of the works. Michelle, the stage is with you. Please go on.
All for this introduction. Central Studies, Office Studies, and FGV for the kind invitation to host this panel today.
Michelle, not hear you.
Yeah, Michelle, we are having some problems with your audio.
Sorry, can you listen to me now?
Hello?
Okay. Can you? Sorry?
Yes,
That's
it's quite
better now.
low, but
Okay,
it has
you.
improved, yeah.
Okay, thank you. Was just thanking Paulo for the invitation to host the panel today, and also thank you, Professor Isaías, for the invitation to host this panel. And I would like to introduce our guests, Professor Victor Polizelli and Professor Fabienne Maher. I hope I pronounced your name well. And Professor Victor is a partner of Caridade Advogados, Dr. Use and Master of Law by the University of São Paulo, and is professor of the master course of the IBDT. Professor Fabian Limarra is partner at Folder Fees Limited, and is Master of Law and Bachelor of Law by the University of Bern. We would have two different presentations, but Professor Victor and Professor Limarra decided to make a joint presentation. So let's start. Thank you again.
Thank you. Thank you, Michel, for your words. Thanks, Professor Isaías and Paulo, for the invitation. It is a great honor to be here today to discuss the treaty with one of the countries where which I have a special affection to. And it was a greater honor to be together with Fabian Limarra, a person who has spent some hours, we spent some hours together already discussing the treaty. That was very enlightening to me. So I also thank you for giving your time for this event and all the preparation. I will share my screen and we'll do this together. So I'll just speak for a few more minutes, and Fabian will guide us through the details of Swiss taxation. We thought it would be interesting from a Brazilian perspective to take a look at some details of how Swiss taxation looks like nowadays. There have been many reforms, right, Fabian? Yeah. So I'll just briefly show you. This is our agenda. It's a lot to cover in the 15 minutes that we have. So I'll pass the word directly to you, Fabian, to tell us a little bit more of Switzerland.
Yeah, then hi, welcome everyone also from my side. So let's start with the Swiss tax environment and also the question, why is Switzerland that famous for it? I mean, first of all, Switzerland is regarded as a safe haven due to its sound economic and political situation. And second, we have a very taxpayer-friendly environment where we can still approach the tax authorities and also discuss certain things with them. So also in a recent meeting with the tax authority of the canton of Zug, they even referred to their taxpayers as clients, which was actually very surprising for our US clients, which they are not used to that with regards to the IRS in the US. In addition, it is common practice in Switzerland also to discuss, as I mentioned, the planned structures and transactions in advance and to obtain legal certainty on the tax consequences by filing a tax ruling request. In this context, I must highlight that you should not confuse a tax ruling with a tax agreement. I mean, because tax agreements are not allowed in Switzerland. So a tax ruling is always in line with applicable law. The purpose of the ruling is just to give the taxpayer in advance legal certainty on how the Swiss provisions will be interpreted and applied by the tax authorities before the transaction is implemented and before the taxpayer incurs costs for the transaction or the structure. Further, Switzerland has also a very extensive network of tax treaties with over 100 countries, which is very important also for international groups. So we have also a lot of headquarters in Switzerland. And another advantage is also our EU-like VAT system with a standard rate of only 7.7%, which is significantly lower than in the EU. There normally you have tax rates of around 20%, so Switzerland is very low in this regard. And unfortunately, Switzerland is also famous for the tax privileges and the banking secrecy, but that actually all lays in the past. So Switzerland, I understand from Victor, was blacklisted in 2010 and then removed again in 2014 when Switzerland and Brazil started discussions to enter into an exchange of information agreement. And I also understand from Victor that Switzerland is still on a gray list because of its tax regimes, such as the holding company or the mixed company status. However, as of the beginning of 2020, the so-called corporate tax reform entered into force, and all existing tax privileges mentioned in this Brazilian gray list were abolished and replaced by OECD compliant measures such as, for instance, the IP box or the super deduction, or also we have now a national interest deduction. And
exactly, that was one of the good things of our interaction. We came to the conclusion that the items currently mentioned in the Brazilian gray list no longer exist in Switzerland.
Exactly. Yes, and Switzerland, now last but not least, is also famous for its very attractive low tax rates. And we will now just directly jump into this topic. So what is the background for these low tax rates? So on the next slide, you see that the main reason for this low tax rate in Switzerland is Switzerland's tax competition. So although Switzerland is a very small country with only around 8 million inhabitants, it is politically divided into 26 cantons, and I looked it up, around 2,300 municipalities. As a consequence, there are 3 levels of income taxation. So we have the federal level, the cantonal, and the municipal level. And further, each canton is largely free to decide on its own fiscal policy. And as a consequence, all the 26 cantons have their own income tax laws. You now probably think that our tax system must be terribly complex, but it's not as complicated as it sounds because of our tax harmonization law. So this law stipulates then the principles according to which the cantons have to design their tax laws. However, they remain free to set their own tax rates as they like. And consequently, the tax burden varies considerably between the cantons and also between the different municipalities within the same canton. And on the next slide.
Let me just ask you something again before we jump into that. Is Fürstentum Liechtenstein, is Liechtenstein part of Switzerland or so aligned to Switzerland that you happen to mention if you see the FL?
It's a separate country, so, but I mean, it's more or less like another canton, but formally it's a separate canton. And actually, they belong to our VAT system and to our stamp duty system, but not to our income tax system. So here you see how the corporate tax rates vary in Switzerland. So if you want to establish a company in Switzerland, then better do that in the canton of Zug with a standard effective corporate tax rate of around 12%, and not in the canton of Bern with a rate of roughly 22%. And needless to say, the corporate income tax is only one of many taxes that a taxpayer must consider. And on the next slide, here we have an overview of all the relevant taxes for companies. So with regard to the corporate income tax, I would also like to mention that we also have a participation exemption. So that means that income or capital gains from qualifying participations are virtually tax-free on the level of a Swiss company due to this participation exemption. And further, some cantons levy also real estate capital gains tax and real estate transfer tax in case of real estate transactions. Then in the second column, we have the VAT, I already mentioned that. And then we also have a capital tax on the net equity levied on an annual basis, but just on a cantonal and municipal level, which is normally very, very, very low. And it's also not actually covered by the tax treaty with Brazil. And then we have a withholding tax of 35% on all kind of dividend distribution, including also liquidation proceeds. And compared to other countries, I mean, 35% is very high. So there it's always important to have a treaty so that this high withholding tax is reduced. And I mean, I will come back to that. There is one exception. So if the distribution is made out of so-called capital contribution reserves, so from actually contributions that were paid to the company and then are repaid, that will not trigger any withholding taxes. And that also in practice gives some structuring possibilities. And what is also very important is that Switzerland does not levy any withholding taxes on royalties, and in principle also not on interest, or not on interest on just normal commercial loans. If you have like a lot of loans and they qualify as a bond, then Switzerland also applies withholding tax on the interest, but in the normal case, there is no withholding tax. And we also do not have any withholding taxes on technical services. And last but not least, we have this 1% stamp duty on the issue of shares and on capital contributions exceeding 1 million Swiss francs. They always discuss, and also now, and they discuss again to abolish it. But in practice, normally, I mean, there are some means to just avoid it because it's a very formal tax. And it only applies if the contribution is made by the direct shareholder. So if, for instance, you make a contribution, or if a grandparent makes a contribution, then the stamp duty will not be triggered, for instance. And there are also some reorganization exceptions where then the stamp duty is also not triggered. And then on the next slide, we have an overview of the relevant taxes for Swiss resident individuals. So in Switzerland, the income tax for individuals is progressive. And also here, it depends on the canton and on the community in which the individual is resident. So the maximum tax rates in the very highest brackets are, depending on the canton, between 21 and 41%. And then also for individuals, dividends from qualifying participation, they are taxed at the privileged or reduced rate. And there are also some additional deductions for expats, for instance. Also for individuals, we have the real estate capital gains tax and real estate transfer tax. And these taxes are especially high if you have a very short holding period. So then you have even like an addition for speculation. So often then you end up with tax rates of around 60%. And there is one unique feature that not many other jurisdictions have actually, that is the principle that capital gains on the disposal of privately held movable assets are tax-free. So if a Swiss resident individual sells its shares in a company and realizes a gain, then this is fully tax exempt. On the other hand, Switzerland levies wealth taxes on a cantonal and communal, municipal level. And these tax rates also vary depending on the location, and depending on the wealth of an individual can even be quite high actually. Further, we also have inheritance and gift taxes, but that's also again on a cantonal and communal level in most of the cantons. But there are some cantons which do not levy such taxes at all, which leads to interesting structuring possibilities. In particular, in cases where the beneficiary is a third party, such as a foundation, where normally very high tax rates apply. And I mean, the gifts and inheritance taxes, I must say that gifts and inheritances to spouses and also to children and grandchildren are in most cantons tax exempted anyhow. So in the normal case, they will not apply. And I will just mention quickly the lump sum taxation regime. I'm not sure whether you have heard of that before. It's a special regime, which is an alternative and simplified method for determining the taxable income and wealth of foreign nationals who are tax domiciled in Switzerland and who are not exercising any professional activity in Switzerland. So that's very important. The people taxed under the lump sum regime are not allowed to work in Switzerland. The tax is then levied on a deemed income, the lump sum, that derives from the annual cost of living. That means, as a starting point, the taxable income is determined on the basis of the total cost of living, which must be at least 7 times the annual rental cost of the taxpayer and his dependents. For federal tax purposes, there is also a minimum taxable income that is 400,000 at the moment. And for cantonal tax purposes, this limit may be lower, depends on the case. And it also must be noted that the lump sum tax regime is not available in all cantons. For instance, the canton of Zurich has abolished this regime a couple of years ago. And although this regime can be very attractive for high net worth individuals, depending on the concrete circumstances and the taxpayer's financial situation, sometimes the ordinary taxation in a low tax canton, such as Schwyz, for instance, could be at least as favorable, because also capital gains are tax-free. And then this person then also is allowed to work in Switzerland, which is also an advantage.
Yeah. One thing that it's worth commenting, the fact that Switzerland is gray listed doesn't cause many problems. The tax rate for privileged tax regimes continues to be 15%. The consequences normally are the application of transfer pricing rules and free cap rules. And the third consequence, which is important for this slide here, is when individuals move to a place where they enjoy a privileged tax regime, they have to prove, make real hard evidence that they moved to that particular area. But I don't think the fact that Switzerland has this lump sum taxation regime would be in itself a reason to keep Switzerland in the gray list. Other European countries also present similar regimes like the UK, Spain, also Portugal. So it's not because of this particular type of regime that Switzerland should still be gray listed.
Exactly, and Switzerland has a couple of treaties, including Austria, Belgium, Canada, or the US, where the lump sum tax individuals can only derive treaty benefits if they include this income in the Swiss tax base. There is it's quite complex in practice, but there are some limitations also based on the treaties. So then let's move on to the next topic, the comparison of income flows before and after the treaty enters into force. So in this table, we have an overview of the applicable residual withholding tax rates, which we would like to discuss based on the graphic on the next slide. So first, let's have a look at the dividends. As I have mentioned, Switzerland levies a withholding tax of 35%, and this withholding tax is reduced under the treaty in principle to 15%. That's the general rule. And to 10% in case of qualifying participations of at least 10%, and in case of a holding period of 1 year. And the withholding tax is even reduced to 0 in case of dividend payments to pension funds or national banks. at the moment, I understand that Brazil does not levy any withholding tax on Brazilian source dividends. So, I mean, the treaty will not give an improvement when it's entered into force.
Actually, the benefits on the Brazilian side, as you can see here, they come for interests, royalties, and services, where the regular 15% can drop to 10% or 0%, and also for the case of royalties and services, payment source in Brazil can now benefit from a 10% withholding rate, whereas in the Swiss side, there is no withholding tax in place for many items, right, Fabienne? So the treaty doesn't really change the situation.
I mean, as I mentioned, for interest, royalties, services, and also capital gains, we do not levy any withholding taxes. So in this regard, the treaty will not, have an improvement in this regard. With regard to the Brazilian side, it looks a bit different.
Exactly. It's kind of very new, because in the Brazilian treaty network, normally the threshold or the limit for withholding tax would be set at 15%, which coincides with our domestic law limit as well. So normally treaties would not change the current situation, but in the case of Switzerland, Singapore, the newer treaties, the rate limit for withholding has been reduced. To my view, the reduction is explained by the fact that up to a few years ago, there was a trend in the definition of the corporate income tax rate around 20%. So it was no longer 35% of the 90s. So most countries in Europe and in Asia are taxing income of companies at 20%. That trend might be reverting right now, we never know. But anyway, due to this trend, I think when you have to split the cake in a double tax treaty, leaving 15% for the source and the remainder for the residents, where you have a total of 20, would not be fair enough. So that's perhaps the reason why nowadays the source limitation has started to be set at 10%. One additional topic that we like to comment, and this is one of my preferred sections of the treaty, is Article 23(2)(b). I challenge everyone in the audience to read this article someday, this part, and try to understand what it means. The first time I read, and second time I read, third time, fifth time, 10th time, I have to come to a conclusion, because it says in the beginning that Switzerland has an exemption. And then Article 23(2)(b) says that exemption would not apply if Brazil exempts the income or if Brazil taxes the income. But that's a very awkward way of saying that the exemption will not apply. Why not saying right away that exemption will not apply whatsoever? But then after discussing with Fabienne, in the Swiss treaty practice mentality, she also acknowledges that the language is very complex. It could have been made simpler, but there's no mistake in that.
Yeah, exactly, because I mean, there are some income categories where we use the exemption method, and that's, for instance, for salary, pensions, and things like that. And in this regard, there is like, if, for instance, pensions are not taxed in Brazil, then Switzerland can tax it. And otherwise, we apply the credit method. And I mean, that's also, of course, the big benefit of the treaty, because now the Swiss taxpayer gets tax credit for the dividends, or I mean, there is no withholding tax on the dividends, but on the withholding taxes on interest, royalties, and also services. And
exactly. So sorry. And the conclusion that we get then is that credit method, and we are showing that by these letter C's here, is the method applicable on the Swiss side for dividends, interest, royalties, and services. And whenever there is exemption, Article 23(2)(b) has a kind of a switchover clause, which looks at what Brazil is doing. Brazil happens to exempt Swiss tax, right? I mean, sorry to jump into you.
And maybe just one thing. I mean, there is this 10% Brazilian withholding tax that is applicable to fees paid out of Brazil for technical services rendered from Switzerland. So in principle, Switzerland also grants a tax credit for this residual withholding tax. However, in practice, this often factually leads to a double taxation of such income, because the tax credit is always limited to the income that is taxable in Switzerland. And in case of technical services, the withholding tax is levied on the total payment. And I mean, the total payment is not the gain and not the effective taxable income, because the company also has expenses to, I mean, receive for this kind of income. And let's assume also that this company is located in the canton of Zug, where a tax rate of only 12% applies. That means that the tax credit will be almost nothing in practice.
Yeah, sure. Well, we can imagine, right, Fabian, when you showed that table with the small rates. So Switzerland, for most cases, taxes the corporate profits below 17%, which is the Brazilian standard for labeling a country as a tax haven. And I can imagine, when Fabian showed that table is the final rate for for all three levels. It's
for
not
all
just the
three
cantonal.
levels, exactly.
It's for all three levels. That's the final. When you have such a low rate, the base of taxation must be broad, right? So it's understandable that there will be limitations and restrictions for credits and for deduction of expenses, perhaps. Otherwise, you cannot have such a small rate. So don't get tricked by the small rates, I would say, because income tax is about a base and a percentage of tax rate. Wonderful. We will highlight some of the peculiar clauses of the Swiss treaty. It was a treaty that brought new clauses to the Brazilian treaty practice, and one of them was a result of the 2017 model and changes to treaty practice of all the countries. So Brazil, for the first time, mentioned collective investment vehicles, which we call here CIVs in Article 1. These are entities, let's say funds, that are not only funds, I'm just saying funds as an example, entities that can be treated as transparent, totally transparent or partially transparent from the country of residence, let's say in the view of Switzerland, for instance. So these entities can benefit from the treaty. They are considered, let's say, persons for purposes of the treaty, even though they might not be considered persons in the view of the residence country. Of course, there are conditions, and the conditions normally involve looking through these vehicles to see who are the investors. In the treaty will only apply. I also highlight here Article 27, when the investors are themselves residents of Switzerland. So funds in Switzerland held by other European country residents will not qualify for the benefits of the treaty. And another character that's new to us is the pension funds. The recognized pension funds is also a result of changes to the OECD model. In Article 3, there is nowadays a suggestion to include pension funds. Brazil has adopted that with Switzerland. And you can see in the protocol, and don't get confused, CIVs and pension funds are different. I would say pension funds are mentioned, especially in Article 10 and 11. As Fabian was saying, they qualify for a 0% withholding tax, so they are taxed exclusively in the country of where they are located. So they will not suffer withholding tax in Brazil for dividends and interest. That's the treatment for pension funds. And CIVs can also qualify for other treaty benefits. And both CIVs and pension funds are expressly mentioned in the protocol. In the case of Switzerland, Fabienne was educating me on the several types of funds that I mentioned. contractual funds, investment companies with variable capital, and especially for limited partnership for collective investments, they don't qualify, but the owners may qualify. And the same goes for Brazil. We have certain special conditions there. In the interest of time, I'll jump to the next slide. In some of these slides, we're just quickly showing some items which have already been discussed in this event here from the perspective of other countries. So I'll be very quick and just highlight what's very special with the Treaty of Switzerland. We don't have Article 9.2, it's a pity, again, but it was the first time, because Switzerland was the first treaty to be signed in 2018. For some reason, there is an express reference in the protocol that, let's say, Brazil will accept transfer pricing adjustment based on the map. This position was already clearly stated in the peer review reports for the map forum. So it is true, we can apply Article 9.2 in all treaties of the Brazil network, not only in the Swiss Brazil treaty, because that is a consequence that arises from the BEPS Action 14, and also for the fact that Brazil removed the reservation that it had in the past against commentaries on Article 25, items 11 and 12. Nowadays, you can apply these commentaries to Brazilian treaty practice. On Article 10, we have an interesting feature, which is a holding period. It's a condition for application of the reduced rate of the 10%. And interestingly enough, this condition can have a retroactive effect. So if at the moment of payment of dividends, the person receiving the dividends has not been holding the investment for 365 days, but if he managed to prove that he held that in the future, that person can request a refund of the withholding tax. And I imagine how this thing will be implemented in practice in Brazil with foreign person requesting a refund of the withholding tax that was duly paid, but because of the treaty, since he held the investment for more than a year, he can then come back and request a refund. We will have to be prepared to put this into motion. As I said, and Fabian as well, Articles 10 and 11 have the exclusive residence taxation for pension funds. In Article 12, as is the practice in other Brazilian treaties, we managed to include in the definition of royalties the leasing of equipment, but satellite transmissions was not included. These two items are expressly mentioned in the Brazilian reservations or in the Brazilian notes to the OECD model. But the last one, to be honest, satellite transmissions has only been included in the treaty with Mexico. There's no other treaty that contains that, so I don't know why we keep on insisting to say this is part of our treaty practice. In reality, it's not. And we included an arising rule in Article 12. We like to do it. We do it in many treaties. The arising rule says, defines the source country. The arising rule is similar to 11.5. And as we will see in a moment, in respect to capital gains, it would be interesting to have an arising rule in the article of capital gains, because we have a very interesting situation there, which calls for a definition of where capital gains arise, and we don't have an arising rule to interpret. We would also like to highlight the anti-PE triangular provision. I will comment briefly and ask for the help of Fabian to go through that. So Brazil normally inserts in almost all treaties a special provision in Article 11, which is not part of the OECD model or the UN model, it's part of the Brazilian practice. We like to include a clause. I'm saying here 11.7, but in some treaties it can be 11.6, 11.8, 11.7 is the average of where this clause goes. And the Brazilian clause is aimed at avoiding the application of treaty benefits. Let's say a 0% withholding tax or 10% withholding tax on interest in case you are paying to a PE established in a third country. In the Treaty of Switzerland, like in some other Brazilian treaties, we don't have that clause. So if you don't have that clause, are you allowed to apply the treaty when you're making payments to, let's say, to the United Kingdom, to a branch of the UBS, the Swiss bank? We don't have that clause, but we have Article 27(4), which has a very special mechanism. Can you tell us about that?
Yes, exactly. I mean, normally Switzerland doesn't have this clause often in its tax treaty. We also have it with the US, actually. And I mean, it's regarding triangular cases. And as mentioned, such a triangular case exists where a resident of a state. So here in our example, the Swiss company has a permanent establishment in the third country and then receives income originating from the source state. So in our example here, Brazil, that is then attributable to this PE in the third country. And I mean, in practice, this might result in a low taxation. So Switzerland, for instance, exempts income attributable to a PE according to domestic law. And in addition, the taxing rights of Brazil with regard to dividends, royalties, and interest are limited by the treaty between then Switzerland and Brazil, according to which Brazil can then only levy the reduced withholding tax. And let's further assume that the third state taxes the dividend, royalty, or interest income only at the very low rate or not at all. And I mean, as a consequence, the income would be subject to a very low tax rate or low tax burden. And to avoid such tax planning, treaty benefits are now denied if the Swiss resident derives the income from Brazil through this permanent establishment in the third country, which taxes less than 60% of the Swiss taxation. As I have mentioned before, the corporate income tax rates are in Switzerland between 12 and 24%. So that also means that depending on the location of the Swiss company, the third state could levy quite low taxes, and then this anti-abuse clause would not apply because 60% of 12% leads to a very low tax rate of around 7.2%. However, I mean, in practice, not that many countries have such low tax rates. And if the PE is completely offshore, such as, I don't know, on the Cayman Islands or in the BVI, then Switzerland would apply its domestic anti-abuse rules and probably challenge that the company has effectively a PE on such an island, actually. And I mean, the second criteria, it's always given because, as I mentioned, Switzerland exempts profits that are attributable to a PE abroad based on domestic law.
Yeah, and the final conclusion then is that we don't have a great restriction against a triangular situation because, as Fabienne was saying, if you're dealing with regular transactions with regular countries, as I was mentioning, a branch of a Swiss bank in the United Kingdom, then you can apply, let's say, the zero rate for long-term financing given by a bank in the United Kingdom, because the United Kingdom taxation is not lower than 60% or 12%. And I wonder how this 60% condition, Fabienne, applies. You know, if it's just a comparison of rates, or if we should come down to comparing, you know, the base as well, because as you were saying, you know, the rate is low, but the base has certain, no, this is kind of new, and treaty practice will show to us how this will evolve in the future. Let's move on. This is a very important topic for Brazil, but I'm pretty sure, you know, other colleagues have already been mentioning that in the other panel, so I'll make it very quick. Article 12, 13, and now it gets tricky because I'm using the numbers of the Brazil-Swiss Convention, and they do not fit. So 13 here is 12A of the UN model, 15 is the 14. So why did Switzerland agree on allowing source taxation for technical services? Is that common?
I think it's just the request of Brazil because I mean, Switzerland tries to avoid it, and there aren't that many tax treaties where we have it. It's, as mentioned here, India, Pakistan, also Thailand, some, I think also Argentina. So there are some countries, but I mean, the treaty policy of Switzerland is normally to not include such a clause.
Right. And we have a combination of possibilities, right? The treaty says that technical assistance is in Article 12, but we heard already in this event that possibly there is an overlapping between Article 12 and Article 13, because both are fit for technical assistance, as well as there is an overlap between Article, let's call it 12A, and Article 14. There is possibly just a variation on the number of days, since Article 14, which is 15 for Swiss, only applies after 183 days. I think there is a potential for discussions because of Article 12B of the UN model. So I mentioned here that automated digital services were not mentioned expressly, as we saw in the Brazil-Argentina treaty. So perhaps we will face discussions in the future because the UN now decided to create a special article just for these types of services, which then creates the possibility of saying that the services were not included already. I don't think that possibility is very easy to put in the Brazilian case, because in our domestic legislation, the definition of technical services already covers automated digital services from a long time. So if we were to apply the Swiss-Brazil treaty with the view or with the application of the domestic law as well, we will end up covering automated digital services. And one interesting feature, I think Article 14, the independent person services, will be abolished in the future if Brazil manages to insert the article for technical services, because there's not much use for that article, especially if we're not inserting the payment clause, the Article 14(1)(c) of the UN model of 1980, which is commonly in the Brazilian treaty network. We didn't include it in the Brazil-Swiss treaty, so if we don't have that, there's no use for Article 14 in our treaty practice. The capital gains article. The capital gains article has a new feature in the OECD model that Brazil has started to apply, which is the anti-abuse rule for cases of sale of, not sale of real estate, but sale of a company that possesses a real estate. So if you sell a real estate or a real estate company, and I mentioned here the numbers are numbers of the items in Article 14. So according to 1 and 4, taxation is split between the two countries. So Brazil can also tax. Also, concurrent taxation is found in the case of movable property of a PE. That's a regular item of this article. And then I highlight here this part in red. If you read Article 14(5), it says that any other property, the capital gains derived from the sale of any other property, capital gains arising in the source state, can be taxed by the source. So any other type of item being sold, let's say companies, investment in companies, will be taxed by Brazil, can be taxed by Brazil and also by Switzerland. It's a concurrent taxation. But then we have 14(6), which also says any other property. So we have any other property on top of another any other property. Two broad concepts, and how can you restrict that? My first reading, I also got confused. We discussed this a lot with you, Fabian. we went down to looking at the treaty explanation. For those of you who are interested in deepening your knowledge on the Swiss-Brazil Treaty, please be aware that you can find in the Switzerland administration website treaty explanation, like the United States and other countries do. So you can find explanations on what was the intention, what was the negotiation. And if you look at this document, it's only available in interesting languages that we speak in Switzerland, that are German, French, and Italian. But you can pretty much navigate in those languages nowadays. But if you read that, you will come to the conclusion then that the idea was to leave to Brazil the possibility of taxing capital gains sourced, meaning paid by a Brazilian purchaser, or referring to a property situated in Brazil. We tax capital gains even though the seller or the purchasers are not residents in Brazil. So that possibility is still alive in the treaty. It doesn't block that. And then item 6 would be for very rare situations. The treaty explanation mentions triangular cases, and I can imagine seller in Switzerland in a property not situated in Brazil. That was the possibility left for Article 14.6. And as you can see,
sorry to interrupt you, but that's one question of the audience. Exactly at that point, what are these gains provided in paragraph 6 of Article 14, sorry, as it provides taxation at the residence, because of what we are used to, that taxation of capital gains are usually in the local of the immovable
property. Yeah.
Just give us some examples so we can.
Wonderful. That was thanks for the question. I think that's precisely the concern. If I were left with only this language here, I can come with a lot of possible interpretations. But one thing, especially because I thought the two articles were talking about the very same thing. They're not talking about the same thing because, as you see, Article 6 excludes Article 5. It's not simply comparing any property with any property. We're comparing any property except 1, 2, 3, and 4 in 5, and the any property that's left for Switzerland to tax in a situation, as I was saying here, is any other property except for the one on 5, right? So the one on 5, and you can only come to this conclusion by looking at the treaty explanation given by the Swiss authorities, which is very helpful, and Fabienne can comment that as well, where they said the intention was to leave to Brazil the possibility of taxing capital gains arising. You see that item 5 says arise, and that's why I was saying I would very much like to have an arising rule, because what means arise in Brazil in 14.5? Arise in Brazil can be certainly a property located in Brazil, and perhaps a purchaser located in Brazil. Well, we must say that purchaser in Brazil, asset abroad, and seller abroad, we don't tax that. There's no, even in domestic law, we don't impose tax in such a situation. So that's the situation that was left for Switzerland. A seller in Switzerland and a property not located in Brazil. And if the payer is not located in Brazil, that would not be relevant for the treaty, right? But let's say the payer is located in Brazil, that's why the treaty is relevant. But if the property is not located here, Switzerland cannot tax. So my view, and Fabienne, please also say your words, is that arising means the property must be here.
I fully agree to that, yeah, to your interpretation. So we also discussed it before, so yeah.
Great. I'll move forward. Make sure we end in time. Some other quick facts. Special of the Swiss treaty in Article 18, pertaining to sportsmen, included a rule for exclusive residence taxation, meaning no source taxation. Normally, Articles Article 17 of the model is all about source taxation, right? But in this case, no source taxation applies when the performance is subsidized with public funds of the other state, of the resident state. So one state will tax the wealth of the other state, right? Article 19 of pensions mentions annuities. Annuities, we've seen it before in other treaties, but it mentions expressly lump sum payments. I think lump sum payments are always included, if not in the concept of annuities, they're included in the concept of pensions, in the case where you don't have annuities. But in this case, they say lump sum payments. And we have a national treatment clause. And I'll give an example here. A Swiss expat living in Brazil will be entitled to deductions for contributions made by him or his employer, by him especially, to Swiss pension funds. So you get a deduction for payments made to a pension fund located elsewhere. That is also a recommendation of the model. And I highlight the fact that, for those of you who are reading this treaty, you can get lost in the words, that there is a translation error in item 13 of the protocol, where it says sociedade. It's not legal entity. The word in English is enterprise, and enterprise doesn't mean legal entity. Enterprise has the meaning of Article 7, which is a business. It's not an entity. So when it says enterprise here, it's meaning the individual doing business without a corporate formation. The prevailing language is English anyway, so that probably is another way. Now, Article 22, which corresponds to 21 of the model, is the first Article 21 in Brazilian treaty practice that agreed with granting exclusive residence taxation, exclusive taxing powers to residents in those rights to the source country. Normally, Brazil has a concurrent taxation in Article 21. So this is the first one where all miscellaneous items will be taxed exclusively at residence. But there is a problem there, because Article 21.3 says that items of income not dealt with in the foregoing articles of this convention and arising in the source country shall not be covered by this convention. We know that the OECD position is that residents can tax and source can only tax where the treaty allows. If the treaty doesn't expressly allow, the source cannot tax. That's the view of the OECD model. But the Brazilian view is that, when I cannot find any article in the treaty, then for sure we can tax. We've seen it recently in some tax rulings involving payments of association fees in the Treaty of Brazil and France. And we might have that problem here as well. So I think, in order for Brazil to duly align with OECD practice, we also have to engage in that mentality where, if it's not covered by the treaty, that means source cannot tax. Right from here. That would be the Swiss view, right? If you apply Article 21.3, you would say there's no source taxation.
Yeah, exactly. And I think, I'm not sure whether in the explanations of the treaty, I think the only thing in this concept and connection was mentioned were like lottery gains and things like that. So, I mean, I think Switzerland, sees the taxation rather limited.
Your shop in Pisa, Michelle, let me know if there's something. Let me 15 minutes left. Great, thanks. Article 26, in the special feature of Swiss practice, Swiss history and evolution in this point, involving group requests. Do you want to go about that again?
Yeah, exactly. I mean, historically, due to our banking secrecy, Switzerland was always very reluctant to exchange information at all in the past. And there was the US made pressure in 2008. And then Switzerland accepted then the first group request in case of US citizens. And there was also a second request in 2013 by the Netherlands. And we were also involved in these proceedings. And back then, the Dutch tax authorities the request for information was based on just a letter sent by UBS, so a Swiss bank, to its clients, stating that they should either provide evidence about their tax compliance or their accounts will be closed. And in other words, the Dutch tax authorities took the position that every UBS client who had received such a letter might not be fully tax compliant. And therefore, they made a group request, and the group was defined, obviously, as all customers of UBS to whom such a letter was sent and who have not provided this evidence that they are tax compliant. And the question is whether this is enough to determine the identity of the taxpayer, or whether this is a so-called fishing expedition. And I mean, a fishing expedition is just a speculative request that has no apparent nexus to an open inquiry or investigation. However, I mean, in practice, there is no clear distinction between the group requests and the fishing expedition available. So what did Switzerland in the case that I just mentioned? They have granted the Dutch group request, and also here now in the Brazilian-Swiss double tax treaty, I mean, it regulates in detail the requirements that the request for information must fulfill. And one of the requirements is also the identification of the taxpayer. However, identification can not only be made by providing the name and address of the person that is concerned, but also by other means, such just describing a pattern of behavior. So in accordance with the current Swiss practice, Switzerland will also allow group requests based on the Brazilian double tax treaty. And as I mentioned, that they will grant actually information quite quickly nowadays.
Exactly. So I saw the presentation on Monday by the Brazilian tax authorities, where it was clear that the Brazil-Swiss treaty emphasizes the need for precise identification of the taxpayer. But I call the attention for this last line here, which is included in the treaty. It doesn't say group requests clearly, but there is a language here which we both, me and Fabian, are interpreting as allowing for group requests. You know, despite the intention of having proper identification, in some situations, group requests are allowed. So this mechanism is accepted. It's just
and actually
domestic practice.
Yeah. And Switzerland also mentions it in the explanation to the treaty that this provision will allow it, that it can be.
Great, wonderful. So I think we only have one or two slides, so we'll finish in time. I think this is the last topic, just in general terms. We have Article 29 of the model, which became 27 here, entitlement to trade benefits. Brazil has been adopting as many specific LOB provisions as possible. So some treaties, like the one with Singapore, have 8 or 9 items in Article 29. In the case of Switzerland, we only selected some of the LOBs. So we have four sections in this article. The first section is the principal purpose test. The second section is not part of the OECD model, to be honest. This clause, as I identified when studying this matter, this clause was imported, or let's say transplanted by Brazil from the negotiation of treaty with South Africa, and South Africa had transplanted this second clause from the Swedish practice. I honestly don't understand why Brazil is worried specifically with the business sectors of shipping, banking activities. The headquarters standard, that's okay, it's part of some of the issues that were discussed in the BEPS project. But I don't really understand why we have been inserting this Article 27.2 in the treaty. What it says is that if the other country introduces in the future a reduced taxation for these business sectors, then the treaty will not apply. But I still, and I repeat that, I wonder why, shipping industry and banking industry would be areas for specific concern from the Brazilian authorities' view. And Article 27.3 and 4, 27.3 is about the ownership and active conducted business test, which we'll see in the next slide, and Fabian will help us with that. And Article 27.4 is the anti-triangular PD provision, which we already commented when discussing the example features. So Fabian, tell us about 27.3.
Let's have a look at this ownership and active conduct of business test. So here in our example, we have an individual who is resident in the third state that owns 100% of a Swiss company. And the Swiss company is a pure holding company that is debt financed, and the Swiss holding company then grants a loan to the Brazilian subsidiary. So the Brazilian subsidiary then pays an interest on such loan, again, back to the Swiss holding company. According to paragraph 3 of 27, the treaty benefits are not granted to the Swiss company that derives such interest income from Brazil, as in our case, more than 50% of the Swiss company are held by a person who is not a Swiss resident. However, as this rule by itself would go very, very far and could also have led to undesirable results for structures formed for economic purposes, Brazil and Switzerland, they agreed on 2 exceptions. So the first exception applies if the shares of, in our example here, the Swiss company, are traded on a recognized stock exchange. I mean, in such a case, there is no abusive situation. And the second exception relates to the substantive business activities. That means that treaty benefits are granted if the entity carries on an actual business activity, which is not just the pure holding of participation and related activities. For instance, if the Swiss company here in our example would engage in an active, let's say, manufacturing business in Switzerland, then the interest derived from the Brazilian subsidiary would still be eligible for treaty benefits.
Wonderful. They say that treaties shortens the distance between countries, and if we happen to coexist or to live closer to our Swiss friends in a certain time, we probably would start saying "Obrigado, filhos," as a combination of our cultures. Thank you very much, José Paulo, Fabian, and everyone.
Thank you, Victor. Thank you, Fabian, for your wonderful presentation and very didactic and in-depth analysis of the treaty between Brazil and Switzerland. And I know we'll have a lot of questions. I would just like to address one to both of you. The treaty is still it's very recently, it's enforced from the last few months, I think. And I would just like to hear your opinion, whether you think that this treaty will improve or not the flow of investments between Brazil and Switzerland. Yesterday, I asked the same question to Professors Ramon and Thomas Balzano, and they answered that after the protocol between Brazil and Argentina was signed, all the Argentinians sold all their investments in Brazil. So I would like to ask you if you think that the same rule occurs from now on.
That's a very speculative question, right? But I think especially because of the actual benefits that the treaty brings in comparison to other European countries, because business is very regional, is very local, right? So if you are to choose between Switzerland and some other neighboring country, or on the view of Switzerland, if you're choosing Brazil or some other neighboring country, of course, having a double tax treaty where you have benefits, clear benefits, I think that helps increasing the relationships. And of course, as Fabienne was saying, we have a lot to learn from Swiss tax administration practice. I remember well staying in Switzerland in the house of friends, and in Switzerland you can call the tax auditor and schedule an appointment. I can do it to a friend and discuss your tax position. I was discussing with Fabian, transfer pricing. Transfer pricing is very negotiable. So if the treaty also helps, there are mechanisms in the treaty for tax authorities to also negotiate and discuss the matters, and I hope these instruments will be more often used in the future. So if we have these instruments, I really trust that the treaty is helpful in optimizing our business relationships. Up to you again.
Yes, and I mean, or they at least state in the explanations to the treaty that, I mean, Brazil is the most important partner in like South America, and also that Switzerland is the 6th biggest investor in Brazil. So also against this background, I think the treaty will be of high importance. And as I have mentioned, also from a Swiss perspective, also to get tax credits. I mean, these are all benefits, and also with the mutual administrative procedures, so all the possibilities. I mean, that of course, these are benefits.
Thank you for sharing your thoughts on this topic. I hope next year, if we will have another opportunity, we confirm these answers. And we have just, it's just 11 minutes, and so our time is finished. I would just like to thank you again for accepting to be here with us. I hope we will have another round of discussions sometime in the future. And I'd just like to thank you again, Professors Paulo and Isaías Coelho. And we'll finish our panel today and our third day of seminar. We would like to invite Professor Isaías Coelho for final words and his final remarks. Thanks. Everybody, Professor Isaías Coelho, the floor is yours.
Thank you, Michelle. It was really a nice session. A lot of food for thought, very competent presentation. This is a work in progress, I think, because we are discussing these matters, and the authorities in both countries and the lawyers and other interested parties are following closely these issues. This is a welcome development in a sense that Brazil is making an effort to open the economy, to attract investment, and to create a better business climate, including for its multinationals, to be able to use Brazil as a hub for investment abroad. So all this is a very welcome discussion. And I want to thank Victor, Fabienne, and you, Michelle, and also Paul for organizing this very productive webinar. And let's continue our work. Tomorrow we have more of it. Thank you very much, and have a good afternoon.
Thank you so much.
Thank you.
Bye, everyone. Thank you.